Okie dokes, folks. Yes, I look rough. This is not about me. Hi. Welcome to my bubble where we do a little bit of adulting, a little bit of healing, and a little bit of creating. Okay, so we're adulting today. We back doing financial literacy, period. Today we're doing like debits and credits. Think balancing your checkbook. For any people who know about finance, think like bank reconciliation, those kinds of things. So, for anybody who may not know anything finance related or anything money related, we're going to get into the details. So, in accounting slash when thinking about, no, not when thinking about, when businesses are handling their books, right? A debit is normally considered an increase in assets or a decrease in liabilities, right? So say you have $30,000 in loans and the government's about to, well, maybe not. But hypothetically the government is, forgiving a percentage of the loans, right? So that check would count as a decrease in liabilities, debit, right? And then, increase in assets. You get money, you get, you get your paycheck, you get a bonus, any of those kinds of things. Increase in assets, right? You buy a house, assets. It doesn't have to just be monetary, it can be tangible. Well, houses get complicated, so let's remain basic. That's a debit. Normally, a credit is the opposite, a decrease in assets or an increase in liabilities. Say you take out another loan, excuse me. Say you take out an additional loan to get a new car, or you refinance all your student loans. So instead of paying all your individual ones, now you have the one new loan. Right? All those kinds of things. Any decrease in assets, you pay your light bill, you pay your rent, you pay all of that. Right? Okay. So if we look at a basic business account ledger, right? Ignore all the extra details. Just look at description through balance. Okay? Very basic. Debits is all the money that go into the account of said business. Credit is all the money that comes out. So looking at the description, you get revenue. You get $80,000 in revenue, say for selling a certain product. Then on January 3rd, you get $15,000 because a business owed you money. That would be accounts receivable. But I found this picture on the internet, so it's all revenue. Say you're just getting multiple payment amounts, right? You have a lot of sales. It's the holidays, Black Friday. Instead of January 6th, say the $100,000 is from everybody buying your Black Friday sales. Buying from your Black Friday deals, right? Okay. Credit is everything related to expenses, everything you spend money on. So, say the business spent $20,000 buying more inventory, and then they spent another $10,000. What are business expenses? Like shipping, to get the product shipped from wherever it was to where the business is held. Another $25,000 from you spend on marketing or anything in that kind of anything in that kind of world. Anything that's an expense, anything that you spend money on. I know I look crazy, but it's alright. That's how it be sometimes when you gotta do adulting and keep track of numbers. Okay. Now, if you watch the balance column, it really puts in perspective / does the monetary tracking of how debits and credits affect the account, right? So say this is a brand new account and on January 1st you deposit $80,000 that you received from just a regular sale, right? Or a business received from regular sales. Your balance is $80,000. Next day you spend $20,000 ordering inventory. So now your account balance is the $60,000. Next day, you get accounts receivable. One of the people that you deal with, they paid their bill that they owe you. Now so they paid you $15,000. That brings your account balance up to the 75,000. The next day you spend 10 grand. Day after that you spend 25. Each time your account goes down, the credits. And then the following 2 days after that, you get 100,000, you get 12,000. So now your ending balance is 152,000. All of your debits add up to the 207,000, and the amount of money you spent was only 55,000. Good. As a business, this is great. You're in the positives, you have a profit. Wonderful. Love to see it. That's how businesses do their ledgers, their not balance sheets, but like, that's how businesses track their numbers, right? Now, you as an individual who, say, the average person doesn't have a business, right? Even though let's say the last year and a half, everybody's been like, start a business, plus the PPP loans. So everybody's like, start a business. Say you're the average person who has no desire to start a business, right? But you have personal finances, which is, if you haven't seen my how to budget video, that's what this whole financial literacy series is about, is giving the average person financial knowledge, basically. If you haven't seen how to budget, go do that. Actually, I think it's on the other side, but whatever. Right? So, for whatever reason, when it comes to personal finances, apparently the numbers are switched. Just keep the logic that debit is the money that comes in, the money that you receive. Credit is the money that you spend. Credit is what you are liable for. And just like people have credit cards, yes, that is money that you get to spend, quote unquote, but it's a liability because whatever your credit card balance is money that you have to pay back. That's what credit cards, liabilities, right? So this picture that I also found online, just Google images, right? If we're looking at this, right, for what you see, everything is described: phone bill, direct deposit, mortgage, lunch, groceries, blah, 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 right? Now, normally, debits are on the left, credits are on the right. Now, in this picture, everything in the left column is all money going out. So, you would think, right? I don't know why people switch them, but whatever. Forget how this is actually labeled. Just stick with me, right? So if we're looking at the descriptors through to the balance. Here, up at the top right, you see $437.50. Say that's your beginning balance, right? Say we're starting in the new, right, this is September. Going into September, your starting balance in your account is $437.50. First day of September, you pay your phone bill. That's $45 even. That comes out of your account. Your balance is now $392.50. Also on the first, your job direct deposits money into your account, so you have $1,000 that you receive. Now your balance goes up to $1,392.50. But it's the first of the month, right? You got to pay your mortgage. That's $500 that comes out. You got paid today, so you bought lunch instead of making lunch. You spent $350. You wanted some cash to carry, so you took out $22. And then on your way home, you went to the grocery store to pick some stuff up. You spent $65. Each line counts as its own thing. Like you can, I wouldn't recommend it, but you can combine, say, lunch and groceries and just put like food or whatever. But that's not, when it comes to, say, like balancing your checkbook, it's going to be detrimental because you're not going to know, okay, like food you spent, but food encompasses groceries, lunch, maybe a dinner that you had with somebody. So each thing should be its own line in the way it is here. Also, so you can keep track of how your balance was each time. So after you paid your mortgage, instead of $1,392, now you have $892. Then after lunch, you have $889. After you got some cash out, now you have $867. Then you went and got groceries. Now you're down to $802 solid. Cool. This is more of a balancing your checkbook type of thing. Now me, My mother has a checkbook, but she has never taught me how to balance a checkbook. But as far as I know, well, from my understanding slash interpretation, balancing your checkbook, I used to always think it really meant, especially once I got into all my like finance and accounting classes, I used to always think it literally meant balance your checkbook in the way of like a balance sheet for a business. The debits have to equal the credits. That's not what that means. From my understanding, and better shown by this picture, balancing your checkbook really just means knowing what your balance is and how you got to that balance from all your expenditures. Well, from all your account activity, period. Say we do this example. Also another picture I found on the internet, right? Say your opening balance is $15,000, right? You spend $500 on groceries. In theory, you would put what here? 14.5, right? Say you do some work, some freelance work that through Upwork. That's what Upwork. Well, I assume that's what that is. Upwork.com. It's a website that you can find freelance work. You do some work on Upwork and you get $1,000. That doesn't go in the same column. It's tracked separately. That's money that came in. So instead of your balance being 14.5, now you're back up to 15.5. Okay. Then you spend money on something that's $200. So now you're at 15.3, hypothetically, right? I'll probably just be typing all the actual numbers in because since this is a picture instead of actually Excel, I can't type the numbers in. So if my math is wrong, whatever's depicted here is correct. But I'm pretty sure I can keep track. Right? So you did this. Now you're up. You got the money from your Upwork work. So now you're at 15.5. You spend money. Say you buy a new dress. That was too, well, my ladies. No, let's keep it unisex. Say you buy some new shoes, $200. Now you're at 15.3. Then you buy a vacation, and for your whole family, I guess, and your all-around trip costs $6,000. So now you're at 9,300. Okay. Then you do something else freelance, or you assist in somebody else in some freelance work, and you get paid another $1,000. So now you're up to 10.3. You buy another. Next day, you buy. I don't know. You go on a shopping spree because you wanted to treat yourself because you've been doing so well. So you spent $1,000. Now you're back down to 9.3 because that basically cancels out the freelance money you got, right? But that's neither here nor there. Next day, you do research. To do the research, you spend $5,500. Say you got to fly in somewhere, right? Because you have to fly to get there, blah, 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 blah. But also, since you did the research, you get paid to do that research, right? So they pay, even though you spent $5,500 to get there and do the work, you get paid $6,000 same day, right? Now, if you want to do the math individually, you can. Like if you want to go from 9.3, subtract the $5,500, then add the $6,000. Be my guest if that's how you want to do it, just so you can keep track. Me, I would just be like, okay, I spent $5,500, but they gave me $6,000. My quote unquote profit is $500 from that. So I would just do 9.3 plus the 500. Now I'm at 9,800. So now your balance is 98. Next day, you're like, I got some shopping money. I've been doing good. I've been behaving. You know, I'm gonna treat myself. Next day, again, you go shopping and you take yourself out to dinner. You spend $2,000. Now instead of, what did I say? 98. Now you're at 78. Bam. Debits, credits. That's how they affect your account. That's how that normally goes. So that's like as basic as it can get. And that's, hopefully that makes sense on like what a debit is, what a credit is, and how it affects you. Okay? But yeah, if you made it to the end of the video and you don't know me, hi. My name's Naori. Stick around. You love it here. Duh. Embrace being a star. Subscribe. Throat is dry. Sheesh. Follow my socials. No Excuses November. I'm basically posting 4 times a week. So there will be something else that interests you, I promise. I will see you in my next video. Bye. I'd rather be smoking weed.